So we will be discussing about the chapter 15, which is titled Errors and Irregularities in the Transaction Cycles of the Business Entities. So what does this implies? Well, businesses and different individuals can have striking different characteristics, but most have some fundamental conceptual characteristics that are being practiced in common. There are three examples of this transaction cycles. First is sales and collection cycle. Second is acquisition and payment cycle. The third one is the payroll and personnel cycle. So these three are important, especially that management should establish control to ensure that these transactions are appropriately handled and recorded. However, if internal controls are not properly implemented or are overridden, frauds and errors may occur. In this chapter, these presents that errors and fraudulent activities that could result in this poor internal control. First is sales and collection cycle. So examples of this are errors in recording sales and collection transactions. So errors in recording sales include mechanical errors, such as using wrong piece or wrong quantity, or recording sales in wrong period, such as cut off, or a bookkeeper's failure to understand proper accounting for a transaction, and so on. Internal controls are designed to prevent or detect many of these kinds of errors. Second type of error is fraud in sales and collection. Frauds in sales generally relate to fraudulent financial reporting. In contrast, fraud in cash collection relates to misappropriation of assets, typically accomplished by clerks or management level employees.
Fraudulent and financial reporting. Fraudulent and financial reporting. Fraud in sales often involves inflating sales or reducing returns or allowances to meet profit targets. Common fraudulent techniques include: first, fictitious sales using fake documents. Second, recording transactions more than once. Third, improperly recording sales in the current period. Fourth, treating lesses or deposits as sales. Fifth, recording consignment sales or likely to be returned sales as actual sales. Sixth, misapplying revenue recognition rules. And lastly, recognizing revenue prematurely. Misappropriation of assets, withholding cash receipts. Number 1. Skimming. This involves taking cash before it is recorded. For example, a cashier doesn't ring up a cell and pockets the money. Another example, an employee records a lower sale amount and keeps the difference. So, it's hard to detect unless gross profit margins or sales volume patterns change unexpectedly. Number 2, lapping. Lapping is a fraud technique used to hide the theft of cash. It involves covering a missing payment from one customer with a payment from another, typically done by employees handling both cash receipts and accounts receivable. This fraud can be detected through routine checks comparing collection records with validated bank deposits. Last, kitting. Kitting is used to inflate cash balances or hide shortages by exploiting the time delay in the banking system. It involves depositing checks into one account and then withdrawing from another before the checks clear. This fraud can be uncovered by analyzing cash transfers around year end.
Errors, accusations, and payment cycle. First is failing to record a purchase in a proper period, cut-off errors. It means when a purchase is recorded in the wrong accounting period, it can misstate both expenses and liabilities. Like for example, a company receives goods on December 29, 2024, but records the purchase on January 2, 2025. So this shifts the expense and liability into wrong year. And the second is recording goods accepted on consignment as a purchase. Good and consignment are not owned by the business, so recording them as purchases is incorrect. Example is A retail store receives products from supplier to sell a consignment, but records them records them as purchases even though it doesn't own the inventory. And the third one is misclassifying purchases as assets and expenses. So expenses should be recorded differently from asset purchases. So misclassification affect financial statement. Like for example, um, buying a computer and recording it as office supplies an expense instead of capitalizing it as an asset is failing to record a cash payment. Missing a cash payment result in overstated cash and understated expenses or liabilities. Like for example, a company pays a supplier 5,000 pesos in cash, but transaction is not recorded in the book. The fifth is recording a payment twice. So this leads to understating cash and overstating expenses or liabilities. Like for example, a 2,000 payment to a vendor is mistakenly entered twice in the system, reducing cash by 4,000 instead of 2,000. And the last is failing to record prepaid expenses as assets. Prepaid expenses like rent or insurance paid in advance should be recorded as assets, not immediate expenses. Like for example, paying 12,000 for a 1 year insurance policy and recording it all as an expense instead of spreading it over 12 months. Entities normally design controls to prevent these errors from occurring or to detect errors if they do occur. When such controls exist, auditor tests the controls to assess their effectiveness. If the controls are not effective, auditors should perform substantive tests to determine that the financial statement do not contain materials misstatement that arose because of possible errors. So in short, if a company internal check don't work, the auditor must dig deeper to make sure the financial reports are accurate.
Paying for fictitious purchases. This scheme involves a person inside the organization, typically someone in accounting, procurement, or management, manipulating the payment system to pay for goods or services that were never actually purchased or received. It's a form of asset misappropriation and can lead to significant financial losses. There are two main variations for paying for fictitious purchases. First variation is the fictitious purchases using fake invoices. In this method, the perpetrator creates a completely fake purchase transaction and processes it as if it were a real business expenses. For example, Jessa is a mid-level procurement officer at a large tech company. Her responsibilities include ordering IT equipment, managing vendor relationships, and approving invoices up to 150,000 pesos. So, para mabuhat ang fraud, Jessa creates or register a shell company. So, what do you mean by a shell company? Shell company are businesses that exist only on paper and has no physical operations, employee, or real assets. Jessa creates or registers a shell company called Techline Supplies using a PO box and her friend's name as the registered owner. Then ang kani nga company kay iyang gi-add sa mga approved vendors list by submitting false vendor registration documents. Then pag next month, Jessa creates a fake invoice from the shell company nga iyang gihimo for items like laptops, monitors, and printer, none of which are ever ordered or delivered. Jessa submits the invoice along with a forged receiving report showing the items we received by the IT department. Since the invoice is under 150,000 pesos and Jessa is authorized to approve it, it goes without further inspection. Then the company processes the invoice and a check is issued to the shell company. The second variation is the duplicate payments or paying the invoice twice. In this variation, the fraudster intentionally pays the same legitimate invoice more than once and diverts the second payment for personal gain. Next to paying for fictitious purchases is receiving kickbacks. So, what is a kickback? A kickback is an illegal or unethical payment made to someone in return for facilitating a transaction or securing a business. It usually involves a person in a position of power, such as purchasing agent, who has the authority to decide which vendor or supplier to use. Ang mo-approach ani kay either ang vendor or ang purchasing agent or employee who has control over procurement decisions. Then ilang sabutan or ni-agree na jud ang purchasing agent na adto Japon siya mopalit sa katunga vendor or for future purchases regardless sa cost, quality, or competitiveness in exchange for a secret payment or gift. Then ang katong nga payment kay maato ang kickback. Then ang mohatag sa kickback kay ang katong vendor kaya ang mga price tubuan man sa vendor para makakover sa kickback. Next to receiving kickbacks is the purchasing goods for personal use. This scenario outlines how individuals within a company, particularly those with authority or access, can misuse their position to purchase goods or services for their own personal benefit while charging the expense to the company's account. This kind of fraud is deceptive because it disguises personal purchases as legitimate business expense. Typically, this type of fraud is committed by executives who have decision making power and the purchasing agents responsible for ordering supplies or services on behalf of the company. So, how is the fraud committed? To successfully carry out this fraud, the perpetrator needs to manipulate the company's procurement and documentation processes. There are a couple of ways this can happen. First, the perpetrator has access to blank documents. The fraudster uses blank receiving reports and purchase approvals to falsify document that a purchase was made for the business. These documents serve as evidence that the goods or services were ordered and received for legitimate business needs. Second, collusion with another employee. Sometimes, the perpetrator colludes with someone in the accounting, receiving, or approval departments. This partner might help by signing off in fake documents, creating false entries in the system, or simply ignoring suspicious transactions. Third is falsifying invoices. The employees may create or submit fake or altered invoices that look like they are from a legitimate vendor. These invoices may list items that appear to be business related but are actually personal.
Historically, errors and irregularities involving payroll have been reported to occur frequently and are largely undetected. It can range from simple miscalculations to intentional fraud. First one is errors. The most errors that can occur in the payroll and personal cycle are paying employees at the wrong rate, which can lead to both underpayments and overpayments. For example of underpaid, if an employee work 50 hours in a week but is only paid for 45 hours, missing out on overtime pay for extra 5 hours. This underpayment can lead to employee dissatisfaction, potentially affecting morale and productivity. Paying employees for more hours than they work. This is an overpayment that can occur, such as employee is paid for more paid time off hours than they accrued. This can lead to financial losses for the company. Next is charging payroll expense to the wrong account. This involves mistakenly debiting a department or project expense account instead of general payroll expense account. For example, a company has separate expense account for each department. Sales department, expense account, marketing expense account. During the payroll cycle, the payroll department mistakenly debits the sales department expense account instead of the general payroll expense account. Last is keeping terminated employees on the payroll. Terminated means end of the contract, whether voluntary or involuntary. This is not removing employees from the system, can happen due to various reasons, including administrative errors, system glitches, or undeliberate decision by the employer. Good internal control can be established to prevent these errors from occurring and to detect them if they do occur. Frauds involving payroll. This is an intentional act. Payroll fraud is the embezzlement of an organization's fraud through breaches in the payroll process, resulting financial losses. The major payroll-related frauds include fictitious employee. Fictitious means something that is made up or imaginary, not real or true. This is also known as ghost employees. These are non-existent or fake individuals listed on a company's payroll to receive wages or benefits. Adding fictitious employees to the payroll is one of the most common defalcations. Detecting fictitious employee on the payroll is very difficult, but auditors do sometimes perform a surprise payoff as a deterrent to this form of defalcation. Alternatively, the auditor may turn the check distribution over to an official not associated with preparing payroll, signing checks, or supervising workers. Personal files and the employee's completed time cards and time tickets may also be examined to substantiate the existence of absent employees. Next is excess payments. Excess payments to employees. This is an overpayment. Increasing the rate above that approved or paying employees for more hours than they worked are the most common ways of paying employees more than they are entitled to receive. These practices can be substantially reduced by requiring personnel department officials to authorize changes in pay rates and by monitoring total hours worked and paid for. Analytical procedures that focus on cost per unit of actual production can also be helpful in detecting excess payments to employees.
Next is failure to record payroll. So, sa rason o ganong mahitabo ang excess payments to employees. So, para malesen ang kaning butanga, kay dapat i-record og tarong sa payroll og para sad matarong ang pagsweldo sa mga employee. Last is inappropriate assignment of labor cost to inventory. So, ang mga company maglisod og meet sa ilang profit target na naka-assign sa inventory labor cost. And there are two analytical procedures para ma-detect ang kaning fraud. First is comparing cost nga na-incurred og dapat ilisan siya og budgeted cost. Second is verification of valuation of inventory. That's all.